You would think you never had a timekeeper before, but anyway, thank you very much, Danny. I'll invite Thomas and Jacob to come up. Just, again, a couple quick points. First is that even prior to our publishing these policy briefs, the charts and the references to the charts will all be posted on our website later today, thanks to our great publications department. And as we are moving into a new era under the leadership of our new director of studies, or newly permanent made director of studies, Marcus Noland, we're trying to be much more transparent about providing people with the data, with the links, and it should all be there. And if it's not, you tell us and we'll get it there. Secondly, just picking up on Danny substantively for a moment, the story often in the U.S., and many of the people in this room have debated it in various ways, has been the issue of, well, we have greater inequality, but we have greater productivity growth, we have greater churn, we have greater rewards for people, we have greater opportunities. And increasingly in the U.S., that has been given the lie. It has become increasingly obvious that that is not true. Lynn Rothschild is very fond of reminding us of Larry Katz has the image of the elevator in the apartment building that doesn't go to the top floor anymore while the lower floors are getting more decrepit. Without stealing Larry's image, I think David's point about do you have inequality in a world of stagnant or declining real wages versus do you have inequality in a world of improvement is a very important one. And when you think about when we grapple with the inequality issue, we don't know what the right answer is yet. We will, of course, get one. But the notion that when you're South Korea in the 50s or 60s, or you're China now, and you're doing this huge catch-up, that if there's widening inequality in a world where you're growing by 8-9% a year is one thing, but widening inequality in a world where you're not growing, or all the benefits of growth are only going to one group is something very different. And the second point I want to make is, again, the resonance between what Danny was showing, and particularly in terms of housing market, participation rates, and these things. These are all things that are primarily domestically driven. This is not about suddenly globalization has made people worse off. This is about, and remember those little diamonds in Thomas's presentation, there is this ongoing long-term trend that inequality has been rising throughout the rich world, and some of that is probably due to globalization. That's the weather I was talking about. There is huge variation which is being created by policy decisions, by business decisions, by labor market institutions in our countries within our control. And that is, I think, a common theme of our three presenters and is something that we intend to continue to pursue. So on that note, so many microphones, it's wonderful. Let me join my colleagues and open this up for discussion. As is our habit, we'll ask that the first couple people from the audience not be Peterson Fellows if they want to make a comment or ask a question. We have a roving mic up front, and there's a standing microphone at back. If you're interested in making a question or a comment, please signal, and we'll recognize you. Yes, please. I think the mic will get to you. If you could just please identify yourself briefly.
Mike Delaney, Office of the U.S. Trade Representative. Well, picking up on what Adam Posen just said, the question I have, and I understand it's beyond the scope of your study, but the question I have is, what is the role of trade in the unemployment and income inequality trends? If the countries you're looking at just have huge disparities in their trade profile. And I would only note, and I guess this is best directed to the good Professor Kierkegaard, that all this happened at a time of pretty robust exports for Germany, and that surely had an impact on labor demand and this sort of thing. So I guess that's my only question. I understand it's beyond the scope of this particular study, but do you have any insights into what is the role of trade in your studies and what in your findings?
No. Jacob, do you want to say something, and then Danny and I'll come in.
No, I mean, there's no doubt that the German net export position has played a significant supporting role here. Germany went from being in deficit, in a small current account deficit throughout the 1990s until the year 2000, and then it basically rose. The current account surplus rose till it hit about 7% or 8%, 7% of GDP right before the beginning of the Great Recession, and then it has pretty much hovered around there ever since. So there's no doubt that in that period, right after the euro introduction, Germany benefited from a huge, export-led growth was real in Germany, no doubt about that. And that was clearly aided by the wage restraint that was exercised. But I guess I would argue that I think that there is a lot of those issues that one underestimates the role of the structural shifts that I described in Germany, but also underestimates Germany is sort of in a unique situation in the euro area because Germany's external economic environment changed completely with the euro introduction. But domestically, not much really changed, right? German interest rate didn't change with the euro introduction. But the opposite is true in everywhere else. So the fact that everyone else in the euro area all of a sudden got German interest rates with the associated ability to, have more leverage, etc., was clearly also very beneficial to Germany during this period.
I wrote a paper some years ago with Matt Slaughter, a trade economist, about exactly this question. And I said something which was kind of controversial, which is that trade economists have been working on this issue for a really long time, and labor economists stopped working on it a decade ago because they knew the answer, which was actually, if you look in the data and if you look at the empirical estimates, including more recent ones and ones that I've done, that it's very hard to see any evidence that trade has had much of an effect on anything in terms of the inequality. And the reason I throw it, and we talked a little about it yesterday, and this is a sort of Richard Freeman point, if you can define 100 occupations if you like. I mean, you can have lawyers and whatever, and obviously some of them are more exposed to trade than others. And in a sense, what you see is the thing that really strikes you is that the changes in inequality is the same within almost all the occupations. So it may well be that there's some underlying thing that we haven't measured, but if you look at each of those occupations, you don't see that. It looks that there's something underlying in all these occupations. It has to do with productivity across that distribution, but empirically, the answer is it doesn't look like trade's doing much.
Yeah,
if anything.
No. I think. Again, it's our job to try to be intellectually honest, not to defend things that are undefensible. But on this point, it actually, the evidence is pretty much there. So you've heard two different cuts. You've heard the case study of Germany. You've heard the essentially cross-sectional stuff that Danny has done, that within occupations that are untraded, you've still seen this massive rise in inequality. But additionally, there's a time series aspect, which is, it goes with what you were pointing out, that you have a period where Germany's trade performance swings a huge amount. You have a period where there's a lot of fluctuations in the relative surplus versus deficit status of all these countries, excepting the U.S., but even there were some big changes. And that doesn't seem to be the driver of the movements in inequality. Mm-hmm. So it is about how you treat your workers and your businesses. Now, that's not to say globalization doesn't matter. So Danny's mentioned work on housing, and of course, the only people who are more annoyed with me these days than the German officials are the housing advocates. But
you and me both.
Yeah, but it's you can argue that the housing booms that we had in Ireland and Spain, and even in the U.S., might have been driven by the so-called surplus of savings around the world, and that may have been part of what threw things out of whack, and that exacerbates certain forms of inequality. That's a legitimate topic for research and discussion. But just to say sort of the traditional, you open up the trade and you end up losing ground, that just doesn't show up in the evidence.
Somebody else, This is incredible stuff that you people have presented.
Sorry, Howard, could you identify yourself?
I'm Howard Rosen here in Washington, D.C., and this is incredible stuff that you've all presented today. I think very useful. And I applaud you, Adam, for the comments that you made. Just want to highlight that people need to be careful on how they interpret these findings, and you were great to do that. And if you don't mind, I just want to highlight one specific thing and then ask a question, which is the reforms, as Jacob said, the reforms in Germany were cross and covered a lot of things. People tend to focus on the generosity of their unemployment insurance system. It's important to understand the starting points of this. And after the reforms in Germany, their uninsurance program continues to be more generous than even the U.S. program under the Emergency and Recovery Act. Okay? So although, your evidence is great, Jacob. It's really helpful and very useful. The people out here need to understand that sometimes we focus on the change and sometimes we need to focus on the levels, and that's very important in this case. Now, that brings me to my question. And I'm not asking you to have an internal fight. I think there's just a good clarification. Jacob, you commented, if I understood correctly, that you didn't find much evidence of the effect of the structural changes on inequality. And yet, Thomas, if I caught it correctly, Germany seemed to be the only one in your graphs that had a negative on inequality. So could the two of you, I don't know if it's just a second decimal point kind of thing, but it seems, so if the two of you could talk about that.
I think the straightforward way to square that is my analysis was for the period of the Great Recession, which is 2007 to 2010, whereas Jacob was talking about the whole of the 2000s, and the reforms happened early in the 2000s. So, if you were to expect any impact on inequality, it would be earlier in the decade rather than in the Great Recession. But certainly it seems that the German labor market has performed much better, even given the size of the shock, and employment has in fact increased, as I've shown in the chart. So that will, given the relationship between employment and inequality, that has tended to push down on income inequality.
I guess I guess it's probably useful here to highlight one of the things that I didn't include in my talk about Germany, which is the issue about short-term work hours in Germany, which the so-called Kurzarbeit provisions, which is basically a system where you can typically it's up to 50% reduction in hours. It is overwhelmingly in the manufacturing tradable sector. And then the government steps in for a short period of time to make up for the decline in the wage income. That was heavily used in Germany. And of course, it means that the overall adjustment of German labor input in that sector is basically distributed across many more workers. Which, of course, has significant implications for overall inequality. But also for inequality of the employed in Germany vis-a-vis the unemployed in these sectors. And now Kurzarbeit and these types of measures were not only used in Germany, but I think it's fair to say that over the period that Thomas used, it was used much more intensively in Germany. And I think from an inequality point of view, this is absolutely the preferable way to deal with what was for Germany, at least, a relatively short-term recession.
Just to say thank you to Howard. We appreciate his backing. He's done so much work in this area, but I think it's very important. He was right to caution us. We're looking at changes. You also look at levels. One thing that Thomas sort of said by the by is, we're trying to scale what those changes in Gini coefficients mean. And I think he said the difference between Ireland and the U.S. was between 0.5 and 0.62 or 0.64. Denmark and U.S., sorry. So, 14 percentage points on the Gini coefficient. The U.S. is still out at the far extreme. So, again, just taking the spirit of Howard's comments, levels do matter. Please.
Bob Samuelson, The Washington Post. Question for Professor Blanchflower and then one for Jacob. You presented fairly convincing evidence that there's very little pressure on wages, and you say that argues for looser monetary policy. Exactly what would you do? Would you just increase monthly purchases? Would you turn the Fed into a kind of credit agency? If a small business can't get a loan from his bank, they can come to the Fed. What mechanisms would you use to ease monetary policy? And then for Jacob, can you elaborate on your response earlier to the previous question, which is it possible that the success that you attribute to these reforms was essentially subordinate in significance to the fact that Germany's export market and structural change, non-structural changes increased aggregate demand and sort of created a climate in which these things would work? They may have reinforced each other, but even absent the reforms, Germany would have done much better than its European neighbors.
I'm going to give it over to Adam in a second. I'm going to go first, but I'm going to get you to go second. My view is that so the Fed, when it started really talking about exit, talked a lot about the unemployment rate, and then it moved a bit to talk about other indicators. And it just seems to me, given this analysis, obviously that I think it should be looking at wages, and I think it's obviously going to be data watching. And I think, in all honesty, given the downside risk that we've seen, the suspicion might be the next move would actually be to increase the amount of QE, not to taper it, but that's a matter for the data. The problem for the US, and I had this conversation with Bernanke, his view is that we are limited by the Congress in what the Fed can do. You have to buy government guaranteed things, so you can buy treasuries, you can buy MBSs because Fannie and Freddie guarantee it, and you can buy short-term munis, but they've never done that. So I don't think, Bernanke's view I know is that under God's green earth, the Congress is not going to agree to it. In the UK, however, Adam's been the chief person pushing for alternative things you might do. So in a sense, it's a dream world for the US, but actually the UK actually has permission now to do some of this. So probably Adam should talk about his great plan. See, I told you I was going to get you to do it.
I know. I am sure Bob and others are upset that it's coming to me instead of you. But
I agree with you. That's fine.
Well, yeah, just quickly. As you know, there are a number of people in this building, including Joe Gagnon and Dave Stockton and Angel Ubide, who are working on variations of this issue, and there's some differences of opinion, although I think most of us were certainly very skeptical of the idea that premature tapering was a good idea. And the thing that Danny is saying that I've been advocating, that I think some of my colleagues have sympathy for, but I won't blame them, is the issue of, can you buy things other than government securities, even long government securities? Because if you believe that one huge impact of how quantitative easing works is you're trying to force people to reallocate their portfolios and take on more risk, and you're trying to get around a banking system that's still dysfunctional, the way you do that is you buy securities that are less like cash. And there's obviously costs and the fiscal politics, some people exaggerate, of this and other issues, but that's what you need. And what Danny has said, and I've written against, is the fact that Congress has very clearly closed off the ability of the Fed to do this for the time being. And I wrote in the FT, I think last summer, a column saying that what the next Fed chairperson should be doing is working to reestablish a relationship with Congress where they get the power to do the kinds of interventions they need for today's world. There seems to be no hope of that right now, however.
Can I just add to that? In the time that I was there, and you didn't do this, but we did, we actually bought $1 billion of private sector assets. So there is precedent, and then Mervyn King got really upset about it. But I would just throw in the context of the UK, and this is Adam's talked about small firm lending. In the UK context, business lending for the last 4 years has been negative in every year, and lending to small firms continues to be hugely negative in every year. And the idea that perhaps you could do something about that through your QE seems eminently sensible. And the question is, well, why haven't we done it?
We should turn to Jacob for Jacob's response to Bob's very sensible question. But one more point on that. As I argued a year and a half ago at Jackson Hole, you want to buy the asset that's going to make the most difference to your economy. Mm-hmm. For the UK and arguably for the Euro area, it's things to encourage small business lending. Mm-hmm. That's where the biggest disruption is, and that's where the greatest dependence is. For the U.S., we've been fortunate that at least until this year, buying agency MBS, buying essentially mortgage securities, happened to be the right thing, or happened to be one of the right things. But if we're starting to see a self-sustaining housing recovery, then comes the question, what else would you want? But other countries have bought things without the world coming to an end. Jacob?
No, I mean, in the case of Germany, I mean, there's no doubt that Germany had the dumb luck of reforming, quote unquote, at the right time in retrospect, vis-a-vis what happened in the Great Recession. But that was certainly not what, no one predicted that. It was because the German business cycle, remember Germany was the sick man of Europe in the early 2000s, and they decided to do something about it. And as I said, I would argue that they did something quite effective about it. But that doesn't change the fact that clearly the wage restraint that they implemented would have helped them even if they had not structurally reformed their labor markets. And the fact that the euro introduction itself, which is really the creation of very, very large wealth effects in the periphery as a result of that, was hugely beneficial to Germany because Germany has an export structure, just as is the case with China, by the way, that they produce a lot of things that the countries clearly wanted at the time. And you can see, if you break down the German current account, that from around 2000 to 2006, a lot of the improvement in the German current account actually comes vis-a-vis the rest of the euro area. But then, as housing bubbles in the periphery begins to taper off, you see that the intra-euro area imbalances actually begin to decline, and it's vis-a-vis the rest of the world. So that today, the German current account surplus vis-a-vis the rest of the euro area is down to about 2%. But is about somewhere between 4 and 5% vis-a-vis the rest of the world, and the relative weight used to be the opposite. But I think it's also important to understand that there is another difference here between Germany and many of the other countries, which is that Germany is a country that has virtually no wealth effects in the economy. It's really, really difficult to create that in Germany. If you look at the German household savings rate, it has basically been around 12%, plus minus 1% since 1960. And if you think about, Germany has, and this ties in very well actually with what David was saying, is that Germany has, together with Switzerland, the lowest home ownership rate in the industrialized world. So even if you had a housing bubble in Germany, which you have not had because you didn't have any real interest in changes with the euro introduction, you probably wouldn't have had many wealth effects. So these these are effects that would have helped Germany sustain or create an external, or if you like, a higher savings rate than investment rates, even if they hadn't reformed in a very comprehensive way their labor market institutions.
Thank you, Jacob. Please.
Yeah,
And
Steve
then if we
Sylvia.
could get the mic to that lady next. Thank you.
Steve Sylvia, American University. This is more of a comment than a question on Jacob. What you've presented, if anything, makes me a bit pessimistic about the broader German economy rather than optimistic. And it makes me pessimistic because when you look at the other data, the headline data on Germany, productivity remains flat. It may not be a big surprise if you're adding employment, but also growth remains flat, investment remains flat. So Germany does not look like a good bet, and if anything, this brings us back to some of the work that Adam's done about the inefficiency of Germany's capital markets, and so I'm curious a comment on that.
No, I mean, there's no doubt that if you look at relative German, contributions to GDP over this entire period since the euro introduction, as I said, early in the euro period, exports was a very significant contributor to GDP growth. But the absent element here has clearly been investments, both on the public and the private side. Now, on the private side, a lot of that has to do with the significant increase in German FDI, actually starting already before the euro introduction, but also right around the expansion of the European European Union with the new Eastern members. And then, of course, you have low domestic public investments, partly as a result of the constitutional debt break that you have. And therefore, this is clearly one of the issues that, in my opinion, the current the Grand Coalition needs to look at going forward. Is how do you raise domestic investments, both on the public and the private sector side in Germany? Absolutely.
Thank you. There.
Hi, Danielle Kurtzleben, U.S. News and World Report. My question, it's another central bank question, is about some of the measures the Fed has undertaken to boost employment. There's also been speculation that also it boosts inequality. And so since we're talking about the intersection of those two, I'm curious about your comments on to what degree that's true and how that dynamic has played out. Thanks.
I always like to respond to questions like that by referring back to Bernanke when he was asked, what would unemployment have looked like if the Fed hadn't acted? And his answer was 25%. So the answer is the stimulus that was put in prevented a situation being much worse than it was. I mean, we can quibble about it. Alan Blinder said it would have been 16%, but I mean, I think it's some very large number. So it seems to me that that benefited all. Clearly, this has had an effect on the asset purchases of boosting asset prices, and those who held assets have done better than others. But the actions of the Fed would have meant everybody, if they hadn't have acted in the way that they had done, unemployment would have been a lot higher, and that's the way that I kind of think about it. And yes, it's had inequality effects, and yes, it's had to compensate for the fact that fiscal policy has probably been doing the opposite to what it should have been doing. But when you've only got limited tools, you do limited things, and given it's limited, it couldn't have done much else. So that's it.
Thank you.
Yes, thank you. My name is Peter Bachfuss. I'm with the International Trade Union Confederation. I'd like to ask a question about Germany as well. Jakob presented a slide showing that the wage restraint, if one compares to other European countries, you can't really see it, that Germany is exceptional in terms of real wage growth compared to other countries, or real wage decline. But I think what sets Germany off, apart from the others, if you look at the data, is this starting from approximately the time of the creation of the euro, is the growing gap between productivity growth and wage growth. I think that's larger. That was larger in Germany than other European countries, and arguably explains some of the trade surplus situations that were asked about in the first question. So that it's another way to look at the wage restraint issue. Is if wages don't keep up with productivity, well, ultimately that's going to create inequality, but also stimulates export-oriented production. So I think the argument can be made that that measures should be taken to encourage wage growth in Germany. Certainly the fact that Germany is one of the few industrialized countries not to have a minimum wage and now might have one.
I'm sorry, Mr. Bacchus. Can you phrase it in the end
Sure.
as a question?
The question would be, does he agree that efforts should be made through minimum wages or other measures to increase wages in Germany so that it catches up to this growing gap between wages and productivity? Thank you.
Thank you.
I think the short answer is that, I would absolutely be in favor of higher wages in Germany. I think the chart that I put up clearly shows that with the somewhat puzzling exception of Portugal, German wages have been below everybody else pretty much in the euro area. Not by enormous amounts, if you look apart from Ireland and Spain, but there is clearly room for German wages to rise relative to the rest of the euro area, and I would certainly welcome it. Now, with respect to the minimum wage, I think I don't actually have strong views for and against it. But I think it's important to understand that if you take the starting point, the 8.5 euro per hour a minimum wage suggested by the SPD, if you then take that to the average weekly hours data, that gives you a monthly minimum wage of somewhere around 1,100 euros per month, which is about what the level would you have in the UK, give or take some PPP changes. It's a little below what you have or it's actually somewhat below what you have in France and Luxembourg and Belgium, but it's not completely out of whack. So that level, I certainly don't think would have that great a relative. It wouldn't revolutionize German inequality, or, for that matter, the German competitiveness situation. Because I think it's important to keep in mind that it would have virtually no effect in the tradable sector, because manufacturing wages in Germany are set by the social partners and already are at a level above that. So it really wouldn't matter very much for the German external position. Where it would matter, particularly, and that's where I think the policymakers needs to be very careful about how they do it, is the regional distribution of jobs in Germany, because you already today have significantly lower levels of wages in Eastern Germany, and the negative jobs effect of such a minimum wage level would be concentrated in Eastern Germany. So I think you would need to have a flexible regional implementation of it, just as you, by the way, have flexible regional implementations of sectorally agreed minimum wages today. And then you would clearly also need, in my opinion, to have a phase-in period. But as I said at the beginning, it doesn't change the fact that there's room for German wages to grow faster than the euro area. Absolutely.
If I can just make one more link, I think it's important to link what Jacob just said, which I think is a very sound, moderate position, with the broader pattern that Danny was pointing out, in the sense that you're seeing, and you raised a very important issue, you're seeing in Germany, despite huge export success for several years, and despite not having a historically, at least for the last couple decades, low level of unemployment and rising participation, wages are not rising. And this is an interesting and very troubling question. We don't have to want to redistribute the entire world to believe that if workers are in high demand and they're competitive and so on. I know I'm not arguing with you on this point, but presumably they should have some bargaining power that would raise wages. And we think about Germany as having relatively well-organized unions like IG Metall and IG Chemie and so on, who should be able to bargain. And Howard and Stephen and others here have worked on this. And it is something of a dog that didn't bark, and it underlines what Danny was saying, both from the short-term policy point of view, but I think also for inequality, that there's something going on there that we don't understand, that you can do very well, and still the fruits, and you cannot be the U.S., and still the fruits of labor are not trickling down.
Can I add to that? I mean, if you think of what determines wages, what we talked a little bit about outside of things. We talked about participation rates and unemployment rates, but there are also inside of things. And what we've seen in the past is that profits feed through into wages through an ability to pay. I think what you've seen are profits have not fed through to wage growth because of an unwillingness to pay on the part of employers. And that's a change, that's something we understand, partly perhaps because maybe there's a link between wages and productivity and so on. But I think we've moved from an ability to pay to an unwillingness to pay on the part of firms. And that's the insider gains have been kept by a group and they haven't been distributed to workers, and that's new. Sorry.
No, this allows me, and then we'll turn to the gentleman back for the last question. One second. This allows me to advertise tomorrow's event here at the Institute, another free lunch with lots of intellectual food. We're doing a half-day conference on Abenomics, and one of the issues the reform in Japan takes on straight on is the question of will wages rise to keep pace with the decline in the yen and the rise in the consumption tax and all these other factors, and if they do not, will that kill off the recovery that's underway in Japan? This is one of the issues we're going to be addressing tomorrow, so please tune in for that as well. Please.
Okay. Nasir Khilji, I'm with the U.S. Treasury Department. In fact, I was carrying on in that conversation of steady wages or real constant wages and the employers keeping most of the gain or one party. One of the things that has been seen in OECD countries, which the panel didn't look at, but it's the compensation share of labor over the last 20 years or so. It's not just a recession, and it has tended to fall, not only in the USA, but in most of these OECD countries. And, one of the interesting paper that was presented at the recent Brookings panel, LBNR, they tried to find some trade-related story going in that bargaining kind of direction. So that's one thing that you may have looked at, and I'd like your views on that. But the other thing you mentioned, especially David, about that maybe Nairu, which is mislabeled anyway, but maybe it's lower than what it ought to be. And as you know, over the last few years, given the way unemployment has behaved in the USA, there has been this tendency to raise Nairu rather than lower it. Especially, even the Fed has come out with papers that have tried to move from like a 5.2. The FOMC recently had projections. Their central tendencies were at 5.4%. So my question to you my question to you is, when you say it's lower than everyone thinks, what range do you have in mind? Thank you.
Before Danny responds, I just want to check whether Thomas or Jacob had anything they wanted to say on the compensation across countries. Okay, so Danny.
Well, we need. I mean, in a sense, it's pretty hard to tell, but it certainly looks to me that there is no underlying wage pressure. I like the view of the forward guidance in a sense of watching the data, but I think if you look back and look at the data we actually have, even in the good times, when unemployment was essentially close to 4.5 or so, we saw absolutely no wage pressure then. So given the movements that I've shown in the housing market and others and other things, it strikes me that perhaps we should be thinking that so-called natural rate is well south of 5. I mean, I think it's well south of 5. Thank
you. Well, we've gotten into a lot of different issues today. This is a very rich field for research. My colleagues and I and others working with us on the Inequality and Inclusive Capitalism project here are trying to wrestle with these, and we appreciate the chance to interact with all of you, tell you where we're going, some of the things we've already uncovered. I'm grateful to Jacob, to Thomas, to Danny. You can all look for in coming weeks, not very long from now, their publications with a fuller expansion of their research. And again, my thanks on behalf of the Institute, to the Aranda Foundation, which has given us the time and means to swing for the fences with a very big ticket issue, which is a privilege not every think tank gets, and we're grateful for that, and we hope that we're contributing through doing that. So on that note, this meeting is adjourned.